Portions of this podcast use AI-generated voices and AI-assisted analysis for commentary and entertainment purposes.
Every time you fire up your phone to, listen to a 30-hour fantasy audiobook on Spotify, you are actually secretly participating in this massive 410 million euro legal war over the definition of a fast food combo meal.
I mean, yeah, it sounds totally absurd when you frame it like that, but that is actually the exact reality of the digital streaming ecosystem right now.
Right, because we just see the seamless app interface, right? You just press play.
Exactly. But beneath that play button is this crazy labyrinth of complex royalty structures, weird accounting maneuvers, and just massive amounts of corporate debt.
Welcome to this deep dive into the source material. Our mission today is to kind of tear down the facade of your favorite audio app and look at the raw financial machinery keeping the music and the podcasts and the audiobooks flowing for you.
And we have some fascinating source material today.
We really do. We are analyzing a highly dense 30-plus page financial document today. It's Spotify's Form 6K, specifically their interim condensed consolidated financial statements for the first quarter of 2026, which ended on March 31st.
Yeah, and to really understand what we are looking at here, you have to place this document in its macroeconomic context, because we were in Q1 2026, right?
Right. Things are volatile.
Very. Companies are navigating global inflation, restrictive interest rates, and just wild foreign exchange volatility. Capital is no longer cheap at all.
No, the free money era is over.
It is over. Yet, in the middle of all these headwinds, the sheer scale of human attention this company is capturing, it's frankly staggering.
Okay, let's unpack this, because before we get into the billions of euros, we really need to quantify that attention. As of March 31st, 2026, Spotify is reporting 761 million monthly active users.
Which is just a massive number.
It's huge. That is up 12% year over year. And of those, 293 million are premium subscribers, which is up 9%. We are talking about roughly the entire population of Europe tuning to one single app every single month.
Acquiring a 12% jump in users when your base is already sitting at over 600 million people, I mean, that requires penetrating entirely new demographics and regions.
Yeah, they can't just rely on the US and Europe anymore.
Exactly. That kind of growth at this late stage of a company's life cycle is just a massive logistical operation.
But looking at the growth numbers, something immediately jumps out to me. A 9% growth in premium subscribers is incredible. But wait, a 1% increase in premium ARPU, which is average revenue per user, that seems incredibly tiny if they just push through all those highly publicized price hikes we've been hearing about.
Oh, the price hikes were definitely real.
So the only way that math works is if they are actively losing money somewhere else in the equation. Are the exchange rates just eating the profits, or are they heavily discounting the service in new markets to, buy that growth?
What's fascinating here is that it's actually a collision of both of those factors. The financial data shows those price increases should have driven the average revenue per user up by 42 euro cents.
Okay, which sounds small, but you multiply that by 293 million subscribers.
And that is a massive revenue injection. It's huge. But the momentum from that price hike was severely dragged down. Unfavorable foreign exchange rates knocked off 24 cents, and then changes in their market mix shaved off another 15 cents.
By market mix, you mean geographic expansion, right?
Yeah, exactly.
Yeah.
As they push into emerging markets, say parts of Asia or Latin America, they have to price the subscription much lower to remain locally competitive.
Because they can't charge U.S. prices in a developing economy.
Right, they'd get zero traction. So that's the underlying tension of global scale. The price hikes in established saturated markets are effectively subsidizing their global expansion.
Wow, okay.
Yeah. So when a strong euro meets revenue generated in weakening local currencies, the translation back to their reporting currency results in that very modest 1% overall bump in ARPU.
Bringing it to just 4.76 per user. So the established users are paying a premium to fund the global conquest. Let's look at how that translates to the top line. Total revenue for Q1 2026 hit $4.53 billion. But the pie chart of where that money originates is, well, it's heavily lopsided.
Oh, incredibly lopsided.
Premium subscriptions brought in $4.148 billion, so 92% of the revenue comes directly from people paying a monthly fee. The ad-supported side brought in just $385 million.
Which is just 8% of the total revenue. And if you look closely at that 8%, the ad revenue is actually down 5% year over year.
Which makes no sense on the surface. I mean, they have nearly 500 million people listening for free with ads. Why is a platform with a rapidly growing free user base losing momentum in its advertising division?
Well, the 6K reveals a structural shift in how digital advertising is being sold on the platform right now. Direct music channel advertising dropped by 58 million.
Meaning what, exactly?
They simply sold fewer impressions through direct custom deals with brands, the old school way. But their automated biddable ad sales actually rose by 45 million.
Ah, okay. So we are seeing a transition away from the custom handshake sales team deals and moving toward like algorithmic real-time programmatic auctions.
Yes, advertisers just want efficiency these days. They are shifting toward automated platforms where they can bid on impressions instantly rather than negotiating premium placement.
That makes sense.
But there is a secondary layer to the ad revenue story here that is essentially an internal accounting maneuver. Effective January 1st, 2026, Spotify moved certain ad-supported revenues into the premium segment.
Wait, hold on. Ad revenue is dropping by 5%, and suddenly they decide to just move some of those ad dollars into the highly successful premium bucket.
That is what the document says, yeah.
Are we sure this is just to align with how the new co-chief executive officers view the business, like the text claims? Or is this, a clever way to mask a failing advertising division inside a thriving subscription division?
Look, it certainly raises the question. The stated reason is operational alignment under the new co-CEOs, who act as the joint chief operating decision makers.
Right, the corporate speak.
Exactly. And it's entirely common for new leadership to reorganize internal reporting lines to match their strategic focus.
Yeah.
However, from an external analyst perspective, blending declining ad revenues into the massive growing premium revenue stream does muddy the waters a bit.
Yeah, it makes it harder to isolate the exact health of the pure ad-supported ecosystem.
It's a classic corporate shell game.
It really is. But regardless of which bucket the money sits in, they pulled in $4.5 billion. But making that money is only half the story, right? Because Spotify essentially just rents the product it sells. The cost of revenue for the quarter was a massive $3.038 billion.
Yeah, that leaves them with a gross margin of 35% for premium and a much tighter 13% margin for the ad-supported tier.
And understanding those margins requires looking at the actual mechanics of how rights holders are paid. Here's where it gets really interesting. Because the mechanism for paying out music royalties is entirely different from how they are now paying for audiobooks.
It is a completely different world.
For the longest time, Spotify operated on a pro rata model for music. It's like a massive toll booth. All the subscription money goes into a giant pool, Spotify takes their cut, and the rest is divided up based on stream share.
Right, so if you listen to music for 2 hours a day or 10 hours a day, your 10 subscription fee doesn't change.
Exactly, and Spotify's cost doesn't really change either. They just slice the same pie into the thinner pieces to hand out to the record labels.
That is the crucial distinction. In the pro rata music model, heavy users don't actively cost Spotify more money on a per unit basis because the total royalty pool is relatively fixed as a percentage of revenue.
But the audiobooks.
Yes, the financial statements specifically note that they are spending heavily on audiobook licensing costs and that those royalties are, quote, consumption-based.
Meaning they pay by the hour.
Precisely. With audiobooks, you are moving away from a pooled revenue share and entering a traditional unit cost dynamic. If a user listens to a 20-hour fantasy epic, Spotify is paying royalties based on those 20 hours of consumption.
Wow.
And if that same user listens to a 40-hour biography the next week, Spotify pays again.
So a super user in the music ecosystem is fine, but a super user in the audiobook ecosystem actively drains Spotify's profit margins. That completely alters their cost structure.
It introduces immense margin volatility. It's exactly why you see limits like the 15 hours of audiobook listening included in premium rather than unlimited access.
Oh, of course. They have to cap it.
They have to cap the consumption to protect that 35% gross margin. Increased music royalties were offset by overall revenue growth, but the consumption-based model of audiobooks is a variable cost. It scales directly with user behavior.
So they cleared $1.49 billion in gross profit after paying the rights holders. But that isn't net income, because it takes massive capital to run a global tech company.
Massive.
Let's look at the operating costs. They spent $331 million on research and development, $342 million on sales and marketing, and $107 million on general and administrative expenses.
And, okay, I have to point this out because it's amazing. Those operating expenses hold a really fascinating mechanical detail.
Okay, lay it on me.
Across R&D, sales and marketing, and G&A, the costs associated with share-based compensation dropped drastically. And it wasn't because of a strategic cost-cutting initiative.
Wait, it was because of social taxes, right?
Yes. If you operate in the U.S., giving an employee stock options is relatively straightforward. But in many European countries where Spotify employs engineers and executives, the company is on the hook for Social Security taxes based on the value of that stock.
Right.
So European tax jurisdictions often assess the employer's tax liability based on the mark-to-market value of the share-based compensation. Because Spotify's share price saw fluctuations and downward movements during the reporting period, the calculated value of the stock granted to employees fell.
Wow.
Yeah. As a direct mathematical result, the company's required social tax provision plummeted by tens of millions of euros.
Which is an incredible quirk of being a publicly traded European tech firm.
Yeah.
Your operating expenses physically shrink just because Wall Street had a pessimistic quarter about your stock.
It's accounting magic.
It really is. But let's translate this back to the user experience and look at the actual cash they're choosing to spend. Sales and marketing is sitting at $342 million, which is up 9% from last year. And the document highlights a staggering detail. They spent $21 million more this quarter compared to last year specifically to provide users with free trials.
The free trial is the ultimate loss leader in the streaming business. When a user signs up for a 30-day or 90-day free trial, they are generating zero revenue for Spotify.
Zero.
But Spotify is still contractually obligated to pay the record labels and publishers for every single track the user streams during the trial period.
So that $21 million increase isn't just advertising spend on billboards or like Instagram ads.
No, not at all.
That is the physical cost of swallowing the royalty fees for non-paying users, functioning as an acquisition cost. They are bleeding cash on those streams, betting that the friction of moving your playlist to Apple Music or Amazon is just too high once the trial ends.
And with 293 million premium subscribers, the conversion pipeline is clearly effective. They are willing to take the short-term margin hit on free trials because the lifetime value of a converted premium subscriber far outweighs that initial royalty absorption.
But all of this margin optimization, the price hikes, the careful management of audiobook hours, it is all built on a very fragile legal foundation. Deep in the commitments and contingencies section of the 6K is a massive legal threat.
Yeah, this is huge.
It's from the Mechanical Licensing Collective, or the MLC.
This is perhaps the most significant existential threat to their margin structure detailed in the entire filing. The MLC is suing Spotify, alleging that the company improperly classified its core premium service as a, quote, bundle.
And the justification Spotify is using for calling it a bundle is the addition of those 15 hours of audiobooks. So what does this all mean? Let's use an analogy.
I love a good analogy.
Imagine you walk into a fast food restaurant. You buy a burger for $5 and a side of fries for $3. A la carte, that's $8. But if you buy them together as a combo meal, the restaurant charges you $6. You expect a discount for bundling the items, right?
That's standard. And the music industry has historically recognized this exact dynamic. Streaming services negotiate agreements that allow them to pay a slightly lower mechanical royalty rate for music if that music is sold as part of a multi-product bundle.
Traditionally, something like a music subscription paired with a video streaming service.
Exactly.
So what Spotify did is add 15 hours of audiobooks to their standard music tier and then turn to the music publishers, the potato farmer supplying the fries in our analogy, and said, hey, we added a burger to the bag. This is now a combo meal, so we are going to start paying you less for your fries.
And the publishers are furious because they never agreed to discount their product just because Spotify decided to give away audiobooks. If we connect this to the bigger picture, the MLC's argument is that Spotify unilaterally relabeled their sole core product as a bundle simply to exploit a loophole and shortchange music publishers.
But didn't Spotify already win an early round of this?
They did. Spotify initially won a dismissal in early 2025, with the court ruling that premium does actually meet the legal definition of a bundle under the current framework. But the MLC has filed an amended complaint and is pushing for an appeal.
And if they win that appeal, the math gets incredibly dark for Spotify.
Very dark. The financial statement outlines a staggering contingency. If the courts ultimately decide premium is not a bundle, Spotify faces a liability of approximately 410 million.
410 million euros.
Yeah. And that liability only covers the period from March 2024 to March 2026. Wow. It doesn't even account for the ongoing higher royalty rates they would be forced to pay moving forward. It would fundamentally fracture their unit economics.
Which perfectly segues into the final piece of this document, the Wall Street mechanics. Because if you have a potential $410 million legal bill hovering over your head, your balance sheet better be pristine.
It really better be.
Spotify generated $721 million in net income this quarter, but they also executed a massive financial maneuver in March 2026. They had $1.304 billion in exchangeable notes mature.
Yeah, these were senior unsecured notes issued back in 2021 when interest rates were near zero.
Ah, the good old days.
Right. An exchangeable note gives the bondholder the option to either be paid back the principal with interest or exchange the debt for shares of the company's stock at a predetermined price.
The critical detail is how Spotify handled the maturity. In a high-interest rate environment like 2026, many companies would try to refinance that debt, just rolling it over into new bonds.
Yeah.
Spotify didn't do that. They settled the entire $1.304 billion entirely in cash.
Paying out over €1 billion in cash is a massive flex of liquidity. I mean, rolling that debt over today would mean taking on new bonds at 5 or 6% interest, which would severely impact their future cash flows. By clearing the debt with cash on hand, they keep their balance sheet unburdened by high-interest liabilities.
But there's a fascinating ripple effect here on their tax bill, right? They made $721 million in net income. You'd assume the tax burden on that profit would be substantial.
You would think so.
Yet their effective tax rate dropped to 23% this quarter. And a huge driver of that was a $47 million tax benefit directly linked to settling those exact exchangeable notes.
This gets into the highly complex accounting treatment of equity-linked debt. When Spotify issued those notes, they included a derivative component because the value of the note was tied to Spotify's stock price.
Okay, I follow.
Over the years, as the stock price fluctuated, the value of that derivative liability changed, creating non-deductible paper losses on their financial statements.
So it looked like they were losing money on paper, but they couldn't actually claim those losses to lower their actual tax bill.
Correct. But when they finally settled the notes in cash in March 2026, they effectively unwound that complex derivative structure.
Oh, wow.
Yeah, the settlement crystallized the financials, reducing those previously non-deductible losses, which ultimately generated a $47 million shield against their taxable operating profits for the quarter.
It is just brilliant corporate finance. You clear your debt, you avoid high-interest refinancing, and the accounting mechanics of the settlement actually lower your tax rate on your operating profit.
It is a huge win for them.
But not all of their investments are yielding positive results. The 6K also updates the valuation of their long-term investment in Tencent Music Entertainment, or TME.
Right. Spotify holds roughly a 9% stake in TME, carried as unlisted equity securities. Because they don't actively control TME, they must carry this asset at fair value on their balance sheet.
And the value tanked, right. At the end of 2025, that 9% stake was valued at $2.18 billion. By March 31st, 2026, just 3 months later, the fair value had collapsed to $1.13 billion.
Driven entirely by the underperformance of TME's underlying stock in the global equity markets.
That is a paper loss of over €1 billion in a single quarter.
It is. Now, it is crucial to note that this doesn't impact Spotify's operating cash flow.
Right.
It doesn't affect their ability to pay server costs or employees. But it drastically shrinks the total asset value sitting on their balance sheet. It is a stark reminder that Spotify is deeply tethered to the volatility of foreign markets and complex global investments.
So let's step back and look at the machine in its entirety. Spotify is capturing the attention of 761 million people. They are slowly squeezing more revenue out of premium subscribers despite the gravitational pull of foreign exchange rates and aggressive emerging market pricing.
Yeah.
They are shifting away from traditional ad sales toward algorithmic bidding, and their profit margins on premium are actually getting healthier.
But that health requires a delicate, high-wire balancing act. They're absorbing massive royalty costs to offer free trials as user acquisition.
Huge costs.
And they are navigating the treacherous shift from the fixed pool economics of music to the consumption-based margin drain of audiobooks. Plus, they are deploying billions in cash to settle old debt while absorbing massive paper losses from their Chinese equity investments.
And the linchpin holding the entire profit model together is a highly contested legal argument about what constitutes a bundle.
Yeah. If the courts rule against them, the retroactive royalty payments alone could consume nearly all of the operational efficiency they've built over the last 2 years.
It really reframes the entire experience of opening the app. You aren't just hitting shuffle on a playlist.
Not at all.
You are interacting with a global financial entity that is actively battling publishers over fractions of a cent, managing complex derivatives to shield their taxes, and hoping their users don't listen to too many audiobooks and ruin the gross margin.
The interface is simple. The machine running it is anything but.
Which leaves me with one final thought for you to mull over. If adding 15 hours of audiobooks to a music subscription legally transforms it into a bundle today, what happens tomorrow?
That's the real question.
We know platforms are desperate to increase the perceived value of their subscriptions. They will inevitably start integrating AI-generated interactive content, exclusive video games, or entirely new media formats we haven't even named yet.
Oh, absolutely.
As the lines between music, gaming, and software blur, how will the very legal definition of a subscription have to evolve to compensate rights holders without completely bankrupting the streaming platforms that deliver it all to your phone?
That is the multi-billion euro question the industry will be fighting over for the next decade.
Until next time, keep listening and keep questioning the machinery behind the music.